September 16th, 1992. London is under siege, not by bombs, not by tanks, but by the foreign exchange market. Inside the Bank of England, officials are burning through roughly $2 billion an hour trying to defend the British pound. Traders are watching in disbelief. And somewhere in the middle of this chaos, one hedge fund manager is about to make financial history. This would become Black Wednesday, the day Britain lost control of its own currency. The government tried everything. Interest rates were raised from 10% to 12%. Then they announced another emergency jump to 15%, but the market kept attacking. By 7:30 that evening, the British government admitted defeat. When the dust settled, the Bank of England had spent around £27 billion in reserves trying to hold the line. The pound still collapsed. UK taxpayers were left with a loss estimated at roughly £3.4 billion. And on the other side of that trade, George Soros and the Quantum Fund walked away with about $1 billion in profit in a single day. That is the headline everyone remembers. The man who broke the Bank of England. But here is the deeper question. How does one investor bet against a major government and win? Was Soros simply a ruthless speculator? Or did he see a fatal weakness in Britain's economic strategy long before politicians were willing to admit it? To answer that, we need to go backward, far beyond trading floors and currency charts. Because George Soros was not shaped in comfort. He was shaped by instability, by danger, and by survival. And those early experiences would later influence the way he saw markets, not as stable machines, but as fragile systems built on human belief. George Soros was born in Budapest, Hungary, in 1930. In 1944, Nazi Germany occupied Hungary, and Jewish families like his were in extreme danger. Soros survived using forged identity papers arranged by his father, Tivadar. In plain English, his childhood taught him one brutal lesson early. Reality can change overnight, and survival depends on seeing through illusions faster than everyone else. After the war, Soros moved to London and studied at the London School of Economics. There, he came under the influence of philosopher Karl Popper. Popper argued that human knowledge is always incomplete and that certainty is dangerous. Soros absorbed that deeply. He began to think of markets not as perfectly rational systems, but as messy arenas shaped by perception, error, and feedback loops. This is where Soros developed the idea he would later become famous for: reflexivity. Most economists assume markets reflect reality. Soros argued something more dangerous, that market participants also distort reality. If investors believe something strongly enough, their actions can push prices, policies, and even economies in ways that make the belief temporarily true. Markets don't just mirror the world, sometimes they bend it. That idea matters because Black Wednesday was not just a currency trade, it was a reflexive trap. The more investors doubted Britain's position, the more pressure they put on the pound. The more pressure the pound faced, the more the government had to defend it. And the more desperately the government defended it, the more the market smelled weakness. It became a doom loop. By the 1970s and 80s, Soros had built the Quantum Fund into one of the most successful hedge funds in the world. But Black Wednesday would become the trade that defined his legend. Still, even this trade was not just Soros acting on instinct. It was a combination of macroeconomic analysis, technical pressure, and one of the sharpest lieutenants in finance, Stanley Druckenmiller. To understand the trade, we need to understand the system Britain had trapped itself inside, the European Exchange Rate Mechanism, or ERM. This system was designed to stabilize European currencies by keeping them within narrow bands against one another. For Britain, that meant pegging the pound closely to the German mark, a political decision that looked disciplined but hid a major economic mismatch. Britain joined the ERM in October 1990 under Prime Minister John Major. The pound was pegged at 2.95 Deutsche Marks with a lower defence limit around 2.77. If the pound fell to that floor, the Bank of England was expected to intervene and buy sterling to hold it up. On paper, it sounded disciplined. In practice, it locked Britain into a system its economy could barely survive. Here was the problem. Britain was already in recession. Growth was weak. Mortgage borrowers were suffering. Unemployment pressure was rising. Inflation in Britain was running far hotter than in Germany. So, while Britain needed lower interest rates to support its economy, the ERM forced it to shadow Germany's monetary conditions. That is where the trap began closing. Then history made the situation even worse. German reunification after the fall of the Berlin Wall created inflationary pressure inside Germany. To control that, the Bundesbank raised interest rates. For Germany, that made sense. But for Britain, being tied to Germany's monetary rhythm was like copying someone else's medicine while suffering from a completely different disease. The policy mix became painful and unsustainable. Soros and Druckenmiller looked at all of this and saw the same conclusion. The pound was overvalued, Britain's economy was too weak, and the government would eventually be forced to choose between domestic pain and currency pride. The market didn't need Britain to be bankrupt. It only needed Britain's defence of the pound to become politically or financially impossible. There was also a technical signal. On the long-term pound versus Deutsche Mark chart, the currency pair had been pressing against the lower edge of its permitted ERM range. To traders, this looked like a descending triangle, a bearish structure where repeated tests of support often end in a breakdown. In simple terms, the floor was being hammered again and again. Stanley Druckenmiller initially wanted to short about $1.5 billion worth of sterling. That was already a massive trade. But when Soros reviewed the setup, he thought the position was too small. If the thesis was right, then Britain was sitting in front of a structural break. Soros reportedly told him to stop being timid and, in effect, go for the jugular. The position was scaled up dramatically, eventually to around $10 billion. That is the kind of size that turns a market opinion into a full-scale financial assault. And this is where many people misunderstand the trade. Soros did not single-handedly overpower Britain through brute force. He aligned himself with a market reality that was already breaking Britain's defences from underneath. So how does shorting a currency actually work? At its core, the trader borrows the currency expected to fall, in this case sterling, and immediately sells it for another currency. If the pound drops, the trader can later buy it back more cheaply, return what was borrowed, and keep the difference. Scaled to billions, small percentage moves become enormous profits. But this only works if the government defending the currency breaks first. And that is exactly what Soros believed would happen. Britain could not lower rates because the ERM demanded strength. It could not keep raising rates forever because the domestic economy was already hurting. It could spend reserves defending the pound, but reserves are finite. Soros was betting against a contradiction. Then came September 1992, when pressure intensified across the ERM. Other currencies were wobbling. Speculators sensed weakness across Europe, and sterling was increasingly in the crosshairs. Once the market believes a central bank's defense is weak, the attack becomes self-reinforcing. Selling accelerates, confidence evaporates, and defending the currency becomes more expensive with each passing hour. On the morning of Black Wednesday, the Bank of England began intervening aggressively, buying pounds in the open market to support the exchange rate. But intervention only works if traders believe the defender has deeper pockets and stronger resolve. That morning, traders saw something else: panic. And once markets smell panic, they do not become merciful, they become predatory. The first emergency move was to raise UK interest rates from 10% to 12%. This was supposed to make holding sterling more attractive. Higher rates mean higher returns for investors who keep money in the currency. But there was a catch. If the market thinks the rate hike is desperate rather than credible, it doesn't restore confidence. It confirms weakness. When that failed, the government escalated further, announcing rates would rise again, this time to 15%. Think about how extreme that is. In a country already dealing with recession and financial strain, policymakers were willing to crush domestic borrowers just to maintain the appearance of currency stability. At this point, Britain was no longer defending a policy. It was defending its ego. Soros and the broader market kept selling anyway. This is the brutal beauty of speculative attacks. Once enough people believe a defense will fail, the act of betting against it helps make the failure more likely. The Bank of England was not fighting one trader. It was fighting arithmetic, credibility, and a market that had decided the peg no longer made economic sense. By the evening, Chancellor Norman Lamont had no choice left. At around 7:30 p.m, the British government announced that the pound would leave the ERM. The rate hike to 15% was scrapped. The defence was over. After all the spending, all the signalling and all the political theatre, the market had won. Britain had blinked, and Soros had been right. Once released from the peg, the pound fell hard. It dropped about 15% against the Deutsche Mark and around 25% against the US dollar. For Britain, this looked humiliating. For Soros and Quantum, it was payday. The short position that had looked aggressive now looked surgical. They had identified a weak structure, waited for the break, and monetized the collapse. The numbers became legendary. Roughly $1 billion in net profit for Soros's fund in just one day. That single trade turned him into a global symbol of financial power. To admirers, he was a brilliant macro investor who exposed unsustainable policy. To critics, he was a speculator who profited from national pain. But whether you love him or hate him, the trade was undeniably historic. But here is where the story becomes even more interesting. Black Wednesday was a political disaster. Yet economically, the outcome was not entirely negative for Britain. Once the pound was free to float, the Bank of England could finally do what the domestic economy actually needed: cut interest rates. That gave Britain room to breathe, and in time, it helped unlock a long period of recovery. In a strange twist of history, some economists later argued that leaving the ERM may have saved Britain from deeper economic pain. After Black Wednesday, the UK enjoyed a long stretch of expansion, roughly 16 consecutive years of growth. That irony gave rise to another phrase, White Wednesday. The day of humiliation also became, in retrospect, the day Britain regained economic flexibility. So was Soros a destroyer, or just the messenger? That depends on how you see markets. If you believe governments can simply declare prices into existence, then Soros looks like the villain. But if you believe markets eventually punish unsustainable policy, then Soros was not breaking Britain. He was exposing a break that was already there. The market made the crack visible. There is also an important lesson about central banks here. Credibility is one of their most powerful assets, but it is also one of the most fragile. A central bank can defend a currency for a while with reserves and rate hikes, but if the underlying economic logic is broken, credibility eventually evaporates. And once that happens, intervention becomes a public spectacle of weakness. Another lesson is that macro trades are rarely about one event. Black Wednesday looks sudden to the public, but the setup had been building for months. Weak domestic conditions, misaligned interest rates, currency pressure, technical deterioration, political stubbornness. Soros did not create those forces. He assembled them into a thesis. The trade was dramatic, but the logic was cumulative. It is also worth remembering that Soros was not trading from certainty. He was trading from a symmetry. If the peg held, the trade could hurt. But if the peg broke, the reward was enormous. This is a classic macro mindset. Find a system where the downside is manageable, the upside is huge, and the establishment is pretending the contradiction can last forever. That same mindset is why Soros became such a feared operator. He wasn't just looking for assets that were mispriced. He was looking for systems that were unstable, narratives that were decaying, and policymakers who were defending positions they could not maintain indefinitely. In that sense, Soros was less like a gambler and more like a stress tester for economic fiction. Black Wednesday also changed the way the public viewed hedge funds. Before trades like this, many people saw currency markets as abstract and distant. After Soros, the image changed. Suddenly, one man with enough capital and conviction seemed capable of humiliating an entire government. That may be an oversimplification, but it reflects something real. Financial markets had become geopolitical actors. And yet, for all the mythology, the trade was not magic. It was analysis plus timing plus scale. Soros understood Britain's political commitment. Druckenmiller understood the market setup. The ERM created the vulnerability. The Bank of England's policy response revealed desperation. Each part reinforced the other. The billion-dollar payday was spectacular, But the real engine behind it was logic. So when people say George Soros broke the Bank of England, that phrase is memorable, but incomplete. The Bank of England broke itself by defending a policy that no longer matched Britain's economic reality. Soros simply placed one of the biggest, boldest, and most profitable bets that the illusion would fail. He didn't create the weakness, he monetized it. In the end, Black Wednesday is one of the clearest examples in modern finance of what happens when politics collides with arithmetic. Governments can delay reality. They can spend billions fighting it. They can even force temporary belief. But when economic fundamentals point one way and policy insists on the other, reality eventually collects its debt, with interest. George Soros made $1 billion in one day because he saw what Britain's leaders refused to see. The pound was trapped inside a system that no longer made sense. Black Wednesday was not just a trade, it was an autopsy of bad policy in real time. And more than 30 years later, it remains one of the greatest and most terrifyingly rational bets in financial history. Like, comment, and subscribe. If you enjoyed the story of how George Soros made $1 billion in one day, then you'll love the story of how Nokia went from #1 in the world to near collapse. Click the video on your screen now. I'll see you there.